This is Scott Beck with the Becker Private Equity Business Podcast, and thank you for listening. If you listen all the way through, send me a text, 773-766-5322. If you love it or hate it, if you're the first person to text on this podcast, 3 stories we're following today, we will send you a $100 Amazon gift certificate, but you can't be someone who's picked up the gift certificate in the recent month or two. So today's story, the title is The Market Rally Slows, 3 Quick Stories. So right now, after a magnificent November in the markets, the S&P 500 up almost 8%, the NASDAQ up almost 10% this last month. We've got a slowing in the stock market rally. The last couple of days have been minorly down. Today looks okay. We'll see how it goes. But there's a lot of stories on this, and you can never believe the pundits, but here's what they're saying. One story, U.S. futures flat today as November rally runs out of steam. That's Yahoo Finance. This week, they also note that we'll see the updates in the third quarter GDP and the Personal Consumer Expenditures Index, which is something the Fed watches closely. The Wall Street Journal writes, stock slip, pausing November rally. And finally, the same thing Citi Strategist says, a Bloomberg article, sharp U.S. rally is running out of steam. Now, that's what some of the pundits are saying. There's another pundit that says, Nubo Rubini, who's a famous market reviewer or prognosticator, says, a more sobering read, this is our second story today, the market bloodbath is likely to continue with investors set to lose tens of trillions over the next decade. And that was covered in Business Insider. That's sort of a negative article, markets, investors set to lose trillions of dollars. That's bad. So what I take out of all this, the market pundits, you could never really know whether the market pundits are right or wrong. They're all right once in a while, just like a clock is right a couple times a day regardless. But the real issue that I take out of this is my third note, is the one thing I've learned over time is you can't trust the pundits, but you do have to spend a lot of time on your own decision about your allocation of assets, equities to bonds to cash. And that's so important because when the market goes up or down, you have to live with your own allocation and either have and get out of the concept of FOMO, the fear of missing out, and embrace the joy of missing out. Look, if you have an allocation that's more conservative, you're going to miss some market rallies, but that's okay because hopefully you'll be able to sleep through the market downturns. The flip side is if you constantly chase the pundits, you're likely to get whipsawed, and most people can't stick with it all the way through those whipsaws. So you're much better off being able to really spend time studying allocations you can live with, and then figuring out what are the core assets that you use to fill out those allocations. So for me on the equity side, so the core assets are the S&P 500 index, particularly the Vanguard one, which is a really low expense ratio. And then on the bond side, my core placement is U.S. Treasury bonds, and let's hope the U.S. Treasury gets itself under control. But those are the 3 things I take out of this. Market rally slows. 3 stories we're following today. Lots of pundits saying the rally is slowing. Dr. Doom, Nubo Rubini saying that the market's really going to go down over the next several years. But what I always come back to is your allocation is everything, and to talk a lot about that. Thank you for listening to this episode of the Becker Private Equity Business Podcast. We did another episode based on a brilliant phrase from Jessica Cole called positive but clear, and we're a huge fan of that. We also had a podcast today on 12 stories we're following at Becker's Healthcare, and that's released into the Becker's Healthcare channel. Thank you for listening again to the Becker Private Equity Business Podcast. Thank you very much.